So thank you for coming. This is Noshi from Trade Genie, and I will be going over the trading systems I follow every trading day. So I go through step by steps, uh, the same process. What I do every day, same process is same stuff. So it's a second nature. So I'll try to explain to you how I do it, and then maybe you can replicate. And if you sign up for any of my service, then you know behind the scene this is what's going on. So when I'm communicating to you through email or Instagram, not the Instagram, yeah, I do have Instagram, the Telegram, so email and Telegram, then you understand the messages I'm conveying and what is going on behind the scene. So it makes you comfortable, and you have to, the person who is following someone, they have to have the same kind of belief, same belief. So it's the same belief system. So if I believe this trade is set up to go down, then when you look at the chart, when you see the trade and when you plug that symbol on your platform, then you can clearly see that, yes, I see it. So for instance, if you plug in on Friday, if you were on my list and you see the Baidu, so I send the trade Baidu short, Baidu puts. So immediately you can see there is a breakdown in the Baidu, and there were airline stocks going down. So when you see and you like it, that's where you will be more um, enthusiastic. Not I'm saying that you get enthusiastic and you bet the farm, but the belief align, and then we are in a harmony, and then you have a better result than when you are following someone when the beliefs are not aligned. Well, that's the way for me. The moment my belief matches with the other person who is talking, um, I got to know that person. And if the belief doesn't match, then I don't follow that person. So it's hard. So I will explain to you. So this presentation, it's a 2 hour or 1.5 hour minimum, is unveiling the secrets of profitable trading systems. So I'll explain to you um, in um, in 1.5 hour. There is another session after this. It's called developing your profitable trading system. So I go over in detail a little more in the background. So another 1.5 hour. Then there is another class I have called what is it? I call it developing your trading system blueprint. So all this go hand in hand. So one after the other. And then I have another session called eliminating your trading mistakes. So if you follow that, then you will learn how to eliminate your trading mistakes, because eliminating the trading mistakes is that's what it is in any endeavor. When you eliminate your mistakes in any profession, that's where the efficiency comes in, and you improve your results. So same goes for the trading. Eliminate the mistakes, operate at 95%, or the top traders, they are operating at a 95% efficiency level, meaning they are not committing mistakes. They're only having mistakes in 5 out of 100. And what do you mean by mistake? Mistake is not about technical analysis, that we have to be right in reading the charts or understanding what the trade will do. It's about all this is stupid mistakes we do. Instead of buying 10 contract, we buying 100, or instead of going long, we buying puts, or chasing the stocks, or chasing the trade, exiting too early, getting excited. All these considered mistake. So I'm going to teach you one of the way I follow, I hope I make some difference. So about 15 years ago, I came across, when I was starting my trading, and I was participating in a Yahoo forum at that time. Somebody mentioned the book called The Science of Getting Rich, and it's written by a grandpa. And if he was alive, I would have kissed his hands. Named Wallace Wattles. So The Science of Getting Rich is a 2 hour read. So I read this book on and off. I've read many times, bought from Amazon. It's available on YouTube. You can listen to this book. So in in his book, he's saying, leave every person you come in contact with the impression of increase. So When I read this, I said, yes, this is so true. So when you're learning something, you create um, your own community, like your friend. So have a friend, accountability partner, your trading buddy, and you share the knowledge. When you share the knowledge, it comes back. And the way it comes back, the people ask you critical question. So they ask you critical question, and then you go and look for it. And eventually it creates abundance. And then there's another quote. He said, you get rich by doing things in a certain way. So what is a certain way? We have to figure it out. All the rich people, they are doing something in a certain way. So look at them and see what they are doing and see if we can adopt some of their success in trading. Another, so one of my mentor, when I was trying to learn everything, and I hear people, I met somebody recently and he's saying, I am trading Forex, I'm trading futures, I do stock trading, I do option trading. So how can you do all that? Is no, it's just you need to be really expert, especially in the beginning of your trading career. You shouldn't be doing all that stuff. So he said, Noshi, you need to practice one kick 10,000 times. When you practice one kick 10,000 times, then you can practice another kick 10,000 times and another kick 10,000 times. Don't practice um, 10,000 kick one time. So think about that. So I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times, Bruce Lee. So this is stuck with me, and I strongly believe in it. Bruce Lee. Then another one is so trading. When we are trading, especially the short-term trading like option trading, we need to trade those stock, whether up or down, which where the lot of other traders or the big boys are involved. So I call them dinosaurs. So dinosaurs. So this is what the quote. His name was Chief. So he was at that time he was 82. So 14, 15 years ago. God bless if he's alive. He's 97, and I don't know where, because he said I'm leaving. I'm going to Caribbean island somewhere in Cayman Island, and he was settling down there. So dinosaurs can run but cannot hide their footprint. So their footprints needs to be detected during the trading hour. This is as simple. So go where the money is flowing in or flowing out, stock tanking or stock mm, moving up with where the big boys are uh, provided. We are not going for where the volume climax is. So we have to understand that there's not a volume climax where we are the last one buying or selling. So a lot of things, a lot of time I see that people posting the charts or sending email. This is our proprietary algorithm and detected these 5 trades. And when I look at those symbols, they're all overbought or oversold. So they are sending something which is either overbought and about to tank, or oversold and about to reverse. So this happened because they don't understand the overbought and oversold level. They don't understand where the trend has started, where the big boys has started their they got involved. So they are looking at the trend. So trend which has been established for a long time and is about to end. So trend which is about to end, they are getting in. So not the trend which is about to end, the trend which is started now, just now, today. So today the trend has started. So how can we figure it out? The trend has started today. So who is starting the trend is the big boys, the waves creator. So there's a lot of, so we can do the research and find out who are the big money is. So the big boys have the complex trading strategy. They are the hedge funds. They are the high frequency traders. They are the institutional players, pension fund, program trading, sovereign fund. They have trillions of dollars. And when they are exiting, they are all exiting from one door, which is from they're jumping from the window. So look at the United airline chart or Delta, or look at the Baidu on Friday. So or look at the Boeing chart. Is tanking. Is is just gapping down. About 2 weeks ago, I had a lunch meeting with two of my friends, and he said, "Well, I think we can buy Boeing, and we can never go wrong." So yes, you can go wrong, provided you are a long-term holder in Boeing and keep buying Boeing. Like right now it's tanking and you have the strategy to add more, but if you bought 3 4 days ago, the Boeing is gapping down, so you will go wrong. If you have options, then you will lose 100% in that trade, so you can go wrong. So now, and another thing, so there is a slide before that I explained in another class, is about you. So me, we are all different, and the trading is different. The investment is different for different people. So a person who is 65 is different than a person who is 25. The different mentality, different mindset, different portfolio size, skills, and experience, etc. So it's different. So one person is different than another, and the market is different too. Every day there is a different market. So what the market is telling us, if not day to day, but then at least 3 4 5 days, um, in we should have a pretty some idea that what the market has done during the last 3 4 days. So market these days is neutral, or you can say choppy. So market is choppy since the 28th of December, and the market established the new trend on 27th of October. So market established a new trend on the 27th of October or 31st of October. It started, and now is what, 14th of January. So 2 weeks, almost 2 months gone by. So what is it? November, December, 2.5 months. So 2.5 months gone by for market to be up. And if you look at the 28th of December, where the choppiness has started, so two months. So at any given time, we need to have a system which fits not only so the trading system should fit us, me, fit you, whatever is your style, and fit that market. So there are a lot of complex thing going on. It's you, then the market, what kind of market it is, and then the system. So at least we need to have two systems, one for the long side, one for the short side, at least two. And if you can only trade on the long side, then you have to trade the inverse symbols which move against the trend. So if we are only comfortable in going long, then we need to find those symbols. When the market is tanking, they are going up. So that's one of the strategy. So at any time, we need to have two trading systems, two direction. You can have multiple trading system for one direction. So I'll explain to you. I'll show you the 12 systems, and then I explain in another class what are those 12 in little detail about each system. So I'll explain to you. So 12 trading system for the long side, 12 trading system for the short side. So at any given moment, what is happening in the market, and then we are applying or using one of those systems. So the overlap, this is the Venn diagram where there is an overlap. So Venn diagram. So this is the market, and this is our system. So not all systems matching the market condition. Only narrow focus. So one or two systems out of whatever 12, 15 we have matching that kind of market, and depending on the market direction. So depending on the market direction, and out of let's say 12 system, 12 long system, 12 short system, the market, whether it's uptrend, downtrend, sideways, we apply, we use the system or the visual. So in the early age, when I was trying to learn 10,000 things and going crazy on the internet and buying books, so again, I was told just master the low risk trading system. So I'll explain the definition of low risk. So master those trading systems where you can use it again and again. It's consistent. Is you believe in it, and there's a reward to risk, where especially where we can see where the risk is, ultimate risk, where we need to exit. So if we define that, Then so we define the boundary, that this is the boundary. We need to exit at when, if we go wrong, this is the ultimate line in the sand. So mastering the low risk trading system, I'll explain to you the definition of low risk. So our job is to develop the low risk trading system, which is um, not easy. It comes with the, you have to spend some time, like 10,000 hours, maybe 15,000 hours. So unless somebody feed you and you magical thing happen to you, you're lucky, and then in 2 hours maybe you can get it. I'm one time somebody sent me email and said, I'm trading Tesla, and I don't know, I I make money and then I lose all, then I bring more money and then I lose all. So I asked him, okay, so what why are you trading Tesla? So that's what I hear. He said, that's what I hear everywhere, people are trading Tesla. I'm buying weekly options. So and so I asked him, okay, how many hours of experience you have? So he started like 2 weeks, just 2 weeks ago, and he is trading Tesla. So Tesla, 2 weeks of experience, weekly options, and he blew up $30,000. So because they don't spend time in developing the low risk trading ideas system, and I explained to you the definition of low risk, and then executing. So development is one thing, and then execution is another thing. So these are two different things. So developing and then executing. You can develop, but you cannot execute. Or you find somebody who has developed the system, you take that system, you cannot execute. So it goes hand in hand. Again, the belief, what we believe. So the person who has developed and the person who is executing, let's say two different persons, their belief needs to be aligned. If the belief is not aligned, then doesn't matter. We will make a boo-boo out of a great system. So develop and execute. So these are some of the trading systems I listed down, and I explained to you in detail in another class. So you can buy a black box. So it's easy to maybe it's easy to buy. You get lucky and you buy the black box, but then the black box is just getting in. You feed the data. On the other side comes out the buy signal or sell signal, and sometimes it's right, sometimes it's wrong, and sometimes it works, sometimes it doesn't work. So ask the person who had developed the black box system and assumptions behind the black box. So assumption behind that indicator which you bought for $49 because you saw an advertisement on YouTube that buy my master indicator for $49 and you can become rich. So that indicator asks on what time frame, what was the condition of the market, how many trades, and what was the win percentage, what is the average gain, what is the average loss. So you would hear they will say win rate 98%. So 98% win rate, 2% loser. So that 98% win rate is like 1%. So 1% gain, and the two losers are 100% losers. So think about that. But the big boys, they have mastered it. They have the resources, 200 years of experience and all the PhDs, etc. So they have developed the black box trading system, and they do that. They make money every day. Chart pattern trading system. So you look at the chart and you can see what's going on. So I use chart pattern. Band trading system, which the lower line of the band, you go long, or if it breaks, then you go short, or if it goes on the top, is touching the top of the band, then you go short. Or if it breaks above the band, then you go long. So people do that. They align. They use the band trading system such as Bollinger, etc., and they uh, use other indicators and then they trade. So it's for good for sideways market. I don't do the band trading. Then there is a trend trading system. So you find those stocks which are establishing the trend, or those who have established the trend and they pull back to a meaningful support or resistance, and then you execute your strategy. Support and resistance trading system. So this is one of the key system is you find the support. The stock is trading, or that market is trading at support, and you go long. You believe in that support, or you go short. You believe in at resistance, this is the strong resistance, and I need to short. So you short or you exit from your long position. There is a breakout system where the stocks break out of the trade consolidation zone, etc., gapping up. So you can use that breakdown system, breaking down the consolidation, breaking down the support, and then there is a gap up system. So I use gap up when there are different kinds of gaps, and you have to know where the gap is occurring in a trend. So the trend is there, and then the gap up is occurring. So where the gap is occurring, and how do you read that gap? Whether the gap up is above the resistance or below the resistance, there is a volume there. What else is going on? And same for gap down system. So when the stock gaps down, what else is happening? So look at the Baidu, look at United Airlines, etc. So gap down, gap reversal. So gap reversal is when the stock gaps up and reversing. The market is bearish, the stock gaps up, and there is no follow through. So you short that market, or gap down, and then you going long because it's hitting some supports. So gap down, gap up, gap reversal, all you can, depending on what's going on in the market. Intraday reversal system, sometimes the stocks just reverses intraday because everything is reversing, some news is there, and you happen to watch that symbol and it's hitting some key level, and then it starts to reverse. That's where you are going long or going short. So intraday reversal system. Then there is the moving averages breakout system, where the moving averages, let's say the 10-day exponential moving average is crossing the 10-day exponential. It's already in the trend because it pulled back to 10-day exponential. If that is your system, you're waiting for a meaningful pullback on some meaningful moving average. And then when it's breaking out from that average, you're going long or breaking down from that average. So put all these system or combination of this. So usually it's a combination of many systems together. So putting 2 plus 2 together. Now, the definition of low risk trade idea. So this is very important. This paragraph has many keywords, and it's important to pay attention to the keywords. So the low risk doesn't mean that we just um, trading and risking only 5 cents. So that is not the definition of low risk. Low risk is everything is low risk or high risk. So anything is low risk, and high risk is how we trade. So I explained to you the definition of low risk. Low risk trade idea is an idea with a positive expectancy. So positive expectancy means positive overall. So you are, when you trade over the long run, the net result is positive. So your portfolio is growing. Doesn't matter loser trade, winner trade, the average of those have a positive result. That's traded at an exposure level. So this is very important, exposure level. This is where we make mistake, the exposure. So exposure level means whenever we bet the farm or we go, whenever we get overconfident in one trade because it's looking so good, and we increase the exposure at such a level that when it goes against us, we lose big time. Uh, so the exposure level. So what is your exposure level? What is your risk level? So maybe they say, experts say that don't risk more than 2% of your overall portfolio in one trade. So no more than 2%. So exposure level that allows you to survive the worst possible contingency. So the worst possible contingency is like the stock gaps down, and you had a plan for let's say 8% stop loss, that I'm buying at 100, and if it goes to 92, I'm out, so I will lose 8%. But then but it so happens some news came up, and then it gapped down, and it's gapped down to 20%. And this happened. So this happened to all of us. So when the stock gaps down and lose 20%, even then you are able to survive in the short run, because you have developed this trading system which gives you the trade where if you take all those trades, you have to qualify them. It's not everything is So what it means is that when your trading system or your visual or chart pattern is giving you the trade, you qualify them from on maybe on a scale of 1 to 10, and then you're only taking the trade which meets the criteria and fall on the score of 9 and 10. So you take all those trades 9 and 10. You trade at a level, exposure level, that even if one of those goes against you more than what you have planned to get out at stop loss, even then you survive, and over the long run you achieve the success. So this is the definition of low risk trade ideas. So now what it takes to succeed, so what it takes to succeed is develop the system, um, you know, be very consistent. If you are um, if you are ignoring a trade, then must have a valid reason to ignore, and if you're taking the trade, must have a valid reason to take the trade. Only you know during the market hours what is how the trade is, you're qualifying the trade. So you must have a trading rules and checklist developed during the planning process. So this lot of planning goes on before we come into the market. So a lot of planning process is done, and then the execution. So when we develop the planning process and have a rules and checklist, we have an edge in the market. So an edge can be as simple as going to bed early and having a good night's sleep, staying away from the like heavy food at night, staying away from alcohol, taking care of health, doing some physicals, staying fit and peaceful, and not having too much going on, like life is upside down. So when we have an upside life down, then we stay away from the market because we are not capable of trading. So the edge could be as simple as doing this thing: sleep properly, have a night sleep early, wake up early, come to market 1 hour early, read the news, prepare everything, and then wait for the market. So it's like, when you come to the market in the morning and you look at the clock and then you say, it's 15 more minutes before the market will start. Not like, oh, the market has already started and I'm coming in 2 hours. Market in San Diego, the market starts at 6:30 a.m. So if I come to the market at 7 a.m., I'm not fit for that day to trade. I should come at 5 or 5:30 and get ready, and ready at 6:15, 6:20, then 6:25. Okay, 6:28, 6:29, 6:30. Okay, market is started. Now we need to watch everything what we have and see which duck is flying where, which way. Are all ducks in control? If they are not, then figure it out how to take action. Now, another step is, so when we are ready, we capitalize on low risk trade ideas. So when we are ready during the day, when the market opens, first we need to take care of all our open position, whether to take the profit, cut it loose, or put them on a monitoring. There is a two type of monitoring. So we do the overview detail monitoring first, early morning, and then one by one, those symbols go into the overview monitoring. So moving it from one basket to another basket, from detail monitoring to overview monitoring, bring it back, only few symbols left where we go into the detail monitoring. And we also on the side, we are stocking the new trade, So there may be a new trade coming. You have a system of stocking it, and the stalking is a form of a risk control. So stalking is another form of risk control, and stalking is another form of increasing the profit. So think about it, instead of going at, you find the trade at 100, and you know the target is 110. So the target is fixed. It's not going to change if you enter at 102 and then you say, okay, I like to make 10 points, so my target is 112. No, that's not the way the trading should work. The target is static. It's there for a reason. You have figured it out that this is where you will exit. It doesn't matter if we if we enter at 105, the target is still 110. If we enter at 95, the target is still 110, because that's the way we are reading the chart. So now, if the target is same and it's not going to move from 110 and is trading at 100, then our job is to decrease our entry and the stop. And we figured out the stop is at 95. the stock is trading at 100, the stop is 95, the target is 110. So we know that. Now we cannot, the only thing we can move is our entry. So try to move, see if the stock is pulling back, and we can time the entry at 99, maybe 99.50, maybe. Sometimes you just don't, if you plan to hold that trade for a longer period, we don't need to haggle over 50 cents, because if the stock is trading at $35 and we try to haggle over 50 cents and try to time the entry at 34.50, and we never achieve it, and by the time and you never enter, and then after 1 year you see that it's stock trading at $70. So for 50 cents haggle, lose that 100% gain. So if that is a long-term trade, so we don't haggle too much over the price. But if it's a short-term trading, we time to, and we are swing trader or day trader, we need to really, if we are swing trader, we need to control our risk, time the entry properly, and then either go long or short. So the scenario is going long. So imagine if you are entering at 100 and the target is 110. So, and you plan to risk a certain number of dollars. So, so it means you need to buy a certain number of shares or certain number of contracts. But if you lower your entry to 98, you can buy more because your dollar amount is fixed. You have allocated a certain dollar amount. So now you can buy more shares because the entry is 98. So when you buy more shares or more contracts, when you're exiting at 110, you have a bigger profit. So stocking is very crucial in the trading success, not only to control the risk, but to increase the profit. So be very precise with entries and exit. Even though you are a long-term trader, you act like a day trader. So that's what I'm trying to say. Even if you're a long-term trader, you act like a day trader. Even if you are a swing trader, you act like a day trader, as if we will be exiting today. So when we adopt this process, we can execute the trade ideas flawlessly and playing the game perfectly, and then have a process of monitoring the open trades in a detailed manner. And then as the time goes by, we step back in a deep, not involved in those symbols, because they are not doing, by looking at the chart every 5 minutes is not going to do anything. Once you determine that this trade is on is like on autopilot, it's not doing anything right now, it's just doing its thing. So looking at the symbol every 5 minutes is not going to help at all. So there must be a system of just watching the price move. So on one monitor, I don't know, it's hard to trade from one screen. So even in one screen, I can trade for limited time. So have one monitor just for watching the price, only the price. So by looking at the price, you know where it is because you have seen it. You know it's trading at 105 and 50 cents, and now it's trading at 105 70 cents or 105 20 cents. So there's not much you can do unless you are about to exit. So when we are about to exit, then we can watch it's 105.20, it's 105.25, then 105.20, then 105.30, all that. So that's where we watch the detail manner. Otherwise, leave it. This is flickering, and you see the bid and ask. So, and then at the same time, be very aware of the market condition throughout the day, especially if you're a swing trader. You have to be aware of the market condition. So doing all this during the day, need to do all this. So now there's another thing. So the market is one, and there's you also. Market is the given condition of the market. You're using the trading system, and then so overlapping, and then the strategy we will use for that given market. We have to know what kind of a strategy we will adopt, because so a strategy also depend on our who we are. So if we don't trade, so if the symbol is moving, let's say Apple is moving, one is option trader, another one is only buys shares, or he buys option and the shares, or he's doing the vertical spread. He may be doing the bull call spread or bull put spread. So depending on what is his trading, what kind of a skills he have, what he likes to do, how much time he has, all that, the same market, same trading system, and a strategy is different, or combination of different strategies. So think about that. So market, trading system, trading strategies is overlap. So another thing is what kind of trading symbols. So not all, we cannot trade all the symbols at any given time. So it's ridiculous. It's really ridiculous when you hear people say that we have a system, 20,000 symbols, we monitor all, and you can trade anything. That's not it's just ridiculous for me. You need to trade the symbols which you have traded before. You understand how they behave, and then you're seeing it, and then you're trading it. So it's like you have 5 children, you know all 5 children, how they, if somebody is quiet, you know why something is going on. He's not quiet, he must be doing something in his room. So it's like that. Or somebody is going wild, so why that kid is going wild. So it's the same philosophy. So do some homework, create your list of the symbols. So I explained to you, so there's a big bucket. So big bucket of like there are 9,000 stocks. So we cannot trade all 9,000. So do some homework and create your basket based on some liquidity, based on the volatility. You don't want to trade swing or options on a dead stock which moves 20 cents. And if you're trading option, then create the basket of a stock which are optionable. Study their option charts, option chain. Some of them have option, but the volume is zero. Open interest is not there. The spread is so crazy. So if you are trading option, if you only want to trade option, you ignore those symbols, and also select the symbols which are in the news. So there's always something going on with that, because for swing trading, you need something which there's a catalyst, some news, something going on. So the stock is moving up and down. So when you apply these principles to the baskets of the stocks, on the other hand, you come out with the different baskets. So I came up with this because I play chess with the children. So chess is one of the game which I think every parent should teach to the children. So that's my belief. I'm telling you my belief that chess, every parent should play with their children, make them smart. So in the chess, we have players: king, queen, knights, bishop, rooks, pawns, etc. So I will explain to you how I define these different baskets. So king, queen, knight, bishop, rooks, pawns, inverse ETF, ETFs, etc. So now I have a different basket, and I flip the basket during the market hour. So I'm looking at the stock which I define as king are those where they are high price stocks. They have their options is crazy. So because they are $1,000 stock or a $2,000 stock, I'm not going to trade options on those only when let's say spread, but I'm not going to buy a $3,000 option or $5,000 option. I'm not doing that. So these stocks, they are just crazy. They are high price stocks. So Adobe, Autodesk, Broadcom, Booking, Costco, Intuitive, KLAC, Lululemon, MongoDB now. So these are high price stocks. So I keep them. So we shouldn't be ignoring it. Just because we don't trade, we don't ignore the high price stocks, because these high price stocks, when they move, they affect the market. And then based on these high price stocks, we can find something related to these high price stocks, something stock which is within our reach. So think about that. Within our reach, we trade those stocks. If Costco is moving up, and the Costco is moving up, every parking lot, the Costco parking lot is full. Like there is no parking. I don't know about where you are, but where I am in Southern California, every Costco is full. So when the Costco is moving up or down, I I don't trade Costco, but then I look at the other retailers and I say, okay, what Walmart is doing or other retailers are doing. So things like that. Now the queens, so I call them queens. They are the ones which I trade, and I send the trade alert like Boeing, Caterpillar, CMI, DE. So if Caterpillar is moving, I'm looking at CMI also. I'm looking at DE or Disney or Etsy. FedEx is moving, then I'm looking at also at UPS, or General Dynamics is moving, then I'm looking at NOC, etc. Those stocks, or Home Depot is moving, and I'm looking at low, or I'm trading low, then I'm looking at Home Depot. So I call them queens, and I look at these. The nights are the special stock. These are always in front of me, and they should be in front of you too if you're trading options. And these nights, and I give you the reason, these are Apple, Airbnb, AMD, Amazon, Baba, Baidu, Coin, CRM, FSLR, Google, etc. This is not the exhaustive list. So I ran out of space, so I just created this. So there's a big list here. So nights, the option spread is very narrow. So very, liquidity is there. They are always moving up and down depending on the direction. Their charts are easier to read. Once you get a hold of them, you can see if you're trading every day or keeping it every one of those, you will be able to catch the move. And they have a certain rhythm. The rhythm is there. Once they get going, they are going. So for instance, the Baidu, it was constantly ticking down, non-stop on Friday. So Baidu was doing that. Non and Coin. So Baidu and Coin non-stop. But if you look at Apple on Friday, there's nothing. I had a long position and I exited. And Apple, um, I've been saying, I said it in way back in July when it made 198. And then again, I was telling at 199.60 that Apple has made a very long-term top at 199. It's hard for Apple to break 199 and 200. It has made a very um, bigger top than all the other symbols I know of. So Apple. So these are the knights. So I do pay attention to the knights. Now the bishops are the smaller other technology stocks, and I pay attention to these the technology stock. These are the Nasdaq stock, and I trade them. Pawns are smaller technology and other stocks. They are there. So all these Nasdaq 100 stocks, I trade them from one day is Shopify, then another one could be Spotify, another one is a team, then another day is a Datadog, if it could be a CYBR, etc. And then the rooks are the ETF. We must watch ETF of these four major markets every day and look at it, the condition, where they are, what they are doing. And sometimes what happened is we just focus on one ETF and we ignore the other ETF. Other ETFs are telling us something. And if they are not in harmony, all these four need to be in harmony, especially DIA, QQQ, and SPY. If these three are not in harmony and one is, sometimes one is become the leader in telling us something, and the other two become the follower. Or if the two are the leaders, the third one who is laggard join the other one. So all four, or especially three, DIA, QQQ, and SPY, they need to move in harmony. So whenever there is a not in harmony, the market is become choppy. So think about that. We need to pay attention to these four symbols. So you see all this going on in the market, but so you don't need too many symbols, 9,000 symbols. You don't need 9,000 symbols. Just don't need. So, and then at any given moment, if Delta comes up with the earning miss or some guidance, then look at, and it has already tanked, then look at other airline. So you flip your workspace or airline and you say, okay, Delta has already gapped up and UAL United has just started. So I may go short on UAL. So things like that. Biotech. So Eli Lilly is the leader, and what else is moving? I can trade Eli Lilly, is too high and is already moving up, but I need to watch other biotech. Sometimes the gold and silver we need to watch. Sometimes financials, they are moving in harmony. If American Express is moving and already moved, maybe I need to watch, what is it, Square or Visa or MasterCard or something like that. Goldman Sachs, JP Morgan. So So you see, COF is repeated here, so I need to fix that. So one financial or two financial moving, what else I can catch? Which one has already moved? Which one has already moved, and which one is just starting to move? Oil is start. If oil is moving up and down, which one I can trade out of major oil stock? Retail, if Costco is moving, I can trade Costco, but it's moving. It has come with a good earning. Maybe I can trade something else. So prepare the list, and there's no shortage. We need only 200, 250 stocks. Laser focus on one of those. So I do that. And the criteria I discussed, I told you about the market analysis. Based on the market analysis, if we read the charts daily, we understand the liquidity, the volatility, we can apply the technical analysis. So don't trade the stock which has no detail. At least you need 2 years of detail. And all these stocks, they are high price, and they have a reason for that price, and they have a history. So if you try to trade the stock with just $2 stock or $5 stock, and it, just go up, you chase it, it's trading at 45 cents, and then you say, okay, buy 5,000 shares or 10,000 shares. I'll buy that 10,000 shares at 45 cents. I will sell it at 60 cents and dream about this big money. And it literally doesn't go from 45 cents to even 46 cents. It doesn't go. It goes to 5 cents. And then you have a 10,000 shares holding. So don't do that. Do and trade only the one where you can apply the technical analysis. You understand fundamental analysis. You understand the option chain. You understand the sectors. You understand there is a news and catalyst. You can read the price pattern. You can read the volume. Volume is not like spiking up on a 1-minute chart. And I will show you what happens. I'll explain to you in a psychological way. Don't trade the stock which 5-minute spike, 5,000% volume. So it's just a spike. Do you really know what else will happen after that 1-minute spike in the trading volume? So don't do that. Proper risk to reward ratio. So if buying 10,000 shares at 45 cents, and then it doesn't even go to 46 cents, the risk is total wipeout in that trade. Total wipeout, zero, never recover it. Whereas if you're trading all these big stocks, the risk is there, but you have a high chance of survival even when the stock gaps down compared to the 45-cent stock or $2 stock or $3 stock. So you get what you pay. So apply all this, and then another. So I'm telling you what I do every day. So you must have a time interval. If you don't have a time interval properly laid out on your trading on your monitors, then you don't know what else is going on. You think the stock is moving nicely on a day chart, but it actually is rolling down. It has already topped out for the day, and you forgot to look at the 5-minute chart or 13-minute chart or 39-minute chart, and it's rolling down. Actually, it's actually moving down. It has reached the top. It just gapped up and reached. So in a daily time frame, there are 390 trading minutes. There are 390 minutes in one regular session. Divide that 390 minutes in equal time frames. Figure it out that if you need equal bars, so 390 divided by 2 is 195 minutes. Maybe you can put a 195 minutes. So you on a day, you have two 195-minute bars. One bar complete, it means half of the day complete, and another day, another bar is started to form. And then if you further divide it, you get 130 minutes. Another one is 78 minutes. Another one is 39 minutes. You get 10 bars equal time of 39 minutes. If you can divide further, it's 13 minutes. And then the lowest, you can don't divide 13 into like you can do 4 minutes or 5 minutes. So 5 minutes is okay. Don't be too much. After 13 minutes, 5 is fine. And then there are some symbols which you can read on the tick charts. The nights, the one I explained to you. So I read them on the tick charts. So you need to read, you should be able to read some selector symbols on the tick chart. So you can go as low as tick charts, which is pure price charts. So have these time intervals and then look at it. This is a long-term time frame, so these are long-term. The trade starts. So when you see a symbol during given day, you put it on a daily time frame, and immediately you have to know uh, the full landscape, where on a daily time frame, where that symbol is trading compared to the previous day move, the last day move. And then quickly look at the weekly time frame also. Don't need to look at the monthly time frame. If we are a swing trader, it's too much. You don't have any benefit of monthly time frame. Weekly time frame is the minimum um, to lean on. To lean on the weekly time frame, look at the daily time frame, and immediately look at the intermediate and short term. So short intermediate time frame should be moving in your direction in the, or if it's pulling back. So when if you see the pulling back, then you have to know where you have to figure it out that the pullback is over. 5 minute is ready, and now I need to time my entry and go long or short. So these are the time frame. Now I explained to you about the process called um, Ebbinghaus illusion. So you can Google Ebbinghaus illusion. So you see there's orange circle and this orange circle. So this orange circle looks smaller than this orange circle. They are actually the same size. So what else is happening around? We get the illusion that this is something big and this is something small. So the idea is, if you are looking at if you're just watching the 5 minute chart, the chart may be looking so good because it's giving you the illusion of bars moving. The constant, there is a 5 minute bar, is this bar, then this bar, this bar, and then so it's looking good. It's giving us the illusion. Whereas on a higher time frame, that chart has no meaning. That symbol, that bar has there's no meaning. It's meeting the resistance, or it's meeting the support, or is the move is not meaningful. There is no volume. But if you are paying attention to the lower, it looks we get deceived. So don't pay attention. Just don't pay attention only to the lower time frame and ignore, because you will get the illusion that this chart is looking good. We are looking at the volume spike, we are looking at the bar, and everything is looking good on a 5 minute, but we are not the scalper. If you're a scalper, maybe you look at the 5 minute chart or 3 minute chart, but if you're a swing trader, you need to go look at the big picture. So don't get this illusion of a lower time frame. So pay attention to that. Don't get deceived, and set some filters, the price filters, volume filters, average true range filters, some change in the price or volume during a given minute. But don't get that illusion that this is something big is happening. If a stock moves 20 cents, so 20 cents move in the last 5 minutes, and then what happened? The move died. Or 500% move in the volume in the last 3 minutes, and then what happened? Is that a volume? Does it have any meaning? So remind yourself. Another thing is you need to set some alerts. So set the alert for opening range breakout, which is meaning there's a time interval and the stock is making a new high or new low. So have a system of checking that the first 30 minutes have gone and now the stock is making its new high. So you need to pay attention, or it's making a new low after the 30 minutes. So whatever time frame you define, so it's called opening range breakout, or it's making a new intraday high or low, get the alert, or it's moved 3% or 2% above the previous close or down. So you pay attention to those. Above average volume, absolute volume, the stock trade at 1 million shares per day and is trading at 1.5 million. So pay attention. Relative volume. So this is another topic. The stock is moving at a 200% above its normal volume that time of the day. So must have some system where you can evaluate the relative volume at this given period is above average. So there must be something going on when the relative volume is high for that time segment. So I have a system, I developed the system of analyzing at any given time segment, what is the relative volume compared to the history. So do that, have a proper support or resistance skill to read, and then when the stock is breaking above or below, then pay attention. Sharp reversal from the support or resistance, have a way of paying attention to those. Some key moving average crossover above or below, pay attention to those. keep moving average because others are paying attention. So there is something called the law of wisdom of the crowd. So the crowd is usually right. So the like the so during the Christmas, we were going to Zion National Park, and so when you go to the Zion National Park, you go through the Vegas, cross the way, you go through the Vegas, and I did not plan to stay on the Vegas, but then there was a just on the strip, we said, okay, let's go through the strip and enter on the one end and go through and exit from the other. So there was lines and lines of cars going to one casino. So the wisdom of the crowd is all these cars going into one casino, lined up, going to one. There's something going on, some event in that casino, which is not happening to other casinos. So the wisdom of crowd. So if something is happening, the and some key figures are being violated, then pay attention because there is a wisdom of crowd. Sometimes the crowd is wrong. So if you can read, if you can understand that the crowd is wrong right now, and I need to pay attention to that, and don't join the crowd. Maybe you have an edge over the crowd, but um, so think about it. How many times you ignore the crowd and you are right, and how many times you join the crowd and you are right. So where is if you come up with the numbers and say, okay, whenever I follow the crowd, there is a wisdom of crowd. So the wisdom of crowd is that the stock is tanking, it has a high volume, the option volume is through the roof, the spread is so narrow, so there must be something going on. So think about that. So and have a proper process of stocking the trade. So two hats. So at any given moment, there's a slide I'll show you some other time. At any given moment, we are, as a trader, especially if we are swing trader, and especially if we are day trader, we are wearing many hats at the same time during the day. So think about it. If you are a day trader, you are entering, you're stocking one trade, you are about to exit from another trade, you're monitoring one trade and seeing if it's behaving properly, and you're doing something else on another trade. So you have 4 or 5 symbols. So because you are a day trader, and if you're a swing trader, you may have a 200 baskets. So your job becomes circular. So you're moving like juggling. So you're putting on the hats. So, but at least you must have 2 hats, even though if you are a long-term trader. If you are a long-term trader, um, we don't jump into the market. We need to act like a day trader. When we act like a day trader, we reduce our risk, and there's a limit. So I gave you the example. If you are a long-term trader and you believe in the fundamental, then don't haggle over the price, because if you haggle for 40, 50 cents, you miss out maybe 1,000% gain in the stock. You never able to enter in that trade. So there has to be some balance. So act like a day trader, even if you're a long-term trader, but figure it out if you are putting too much and haggling over the few cents. So now the definition of stocking. So I'll explain the definition of stocking, and we need to pay attention to the stocking process. So the essence of stocking is to find the best possible price for entry. Thus, stocking is another form of risk control. So we reduce our risk and when we reduce the risk, the exposure, the risk, what we are doing is not only decreasing the risk, but we are increasing the dollar amount we will make when we exit from the trade at a profit. So imagine, instead of entering at 100, the exit is 110, you're entering at 98. So you're buying more shares. So when you exit at 110, you make more money. And then if you lose, when you exit, so when you enter at 98 and when you exit at 95, you will lose the same dollar amount. So your dollar amount is loss amount remains the same, but your profit goes up, but just by adopting the process of stocking. So do that. So I go through all that, and I have a team who is assisting me. So there are a lot of things goes on. Initially, I was trading on my own, but as things develop, and then I keep doing the adding things, adding. So I need the team. So there's a team behind. So let's say we find that there's a trade in Apple. So there's a simple subject line. You receive an alert on this via email and Telegram. Simple that Apple buy calls. The month is February. Strike is 180, and then a price buying to open at 5. So this is the valid price at that moment when the alert is generated. And I watch the price. If it moves to 510, suddenly then I send you the alert, the pay of 510, but it's usually the same at 5. And in the email, when you open the email, the details are there. But if you read the subject line is there, and on your Telegram, this is the message you read. In the Telegram, there's no detail. It says detail in your email, so you read the email and you will find the detail. But this is what you, if you have a Telegram on your phone and you're driving, so just pull over and execute the trade at 5. After, so you put your limit orders. Uh, don't chase it. It's not like this. The stock is just exploding, and sometimes it does, but so you miss it. But most of the time, it's just within the limit. So you put your limit orders, and when you receive, so soon you will receive the targets, and I call it green, yellow, and red. So I define the targets into 3 different categories. So you receive the target and you can see there is a potential. So you have to decide whether if instead of buying 5 contracts, maybe you bought 2 contracts and paid little extra. So what that extra is this. So this is defined in the trading system and guidebook. Pay a little extra. It's okay if you pay 5 cents and the option is trading at dollar. It's okay to pay 50 cents when you're trading buying Tesla, let's say, and the options are between 12 and 20. So if you buying, let's say the price was 12.05 and I send the alert and it's trading at 12.40, 12.50 and it's a Tesla, you can pay because the option, the contract gain is 400, 500. So don't haggle over 50 cents when the option is 12. But I don't send this trade often. So this kind of trade where the option price is high requires a higher portfolio size. So it's not for all portfolio. Generally, the trade is between the middle, between 4 and 6. So mostly the trades are between $4 and $6. And mostly I buy in the money strike. So it depends on the market conditions. Also, it depends how many position we have and what else is going on, the momentum, etc. Mostly the trades are in the money strikes. So if you're buying out of the strike, out of the money, then you have to be right quickly and you believe in the momentum. Or maybe you're just taking something, your big event is coming up and you just buy 70 cents. So when you buy 70-cent option, the moment the stock moves against you a little bit, that 70 cents turn into 50 cents, then it turns into 40 cents. So when we are buying 70-cent option, we need to know that we can lose all because it's a 70 cents. So there's a difference between a 70-cent option and a $12 option. So that's the thing about that. So what the traders do is, let's say they buy 70 cents and then they put the stop at 50 cents. So that's so loss is 20 cents. So let's say buy at 75 cents. And you put the stop at 50 cents. So think about this. You're buying an option at 75 cents. If you put the stop at 50 cents, which is 33%, so 25 cents for the option is nothing. It just move up and down. You are choking yourself by putting a very tight stop. You'll be stopped out all day long if you do that kind of a trading. Buying at 75 cents and then putting the stop at 50 cents, and then you're getting stopped out. So think about what uh, when you're buying it, this kind of option is 100%, either 100% loser or 100% gain or 200% gain. So again, the definition I gave you the example, the exposure level. So the exposure level is such that even at the short term, you suffer a drawdown, you come out as a winner. So if you're trading a 70-cent option, even it goes 100% loss, you come out as a winner because you have a system of, unless you have all the option trading at 100% loss, and it happens maybe on the weekly option. So that's where people trade Tesla. They trade weekly options. They get caught. They increase their portfolio, and then eventually they get caught, and the music stops. So you don't want to trade like that. So this is some guidelines I have. If you get filled, partial, cancel the order. Don't leave your buy order forever. If it doesn't get filled in 5 minutes, cancel it. Look at the chart, see if there's a pullback, and then time your entry and enter again. You have a reference point. So do that. Don't leave the buy order good till cancel. So don't do that. The buy order is only for valid for a few minutes, or valid is for not even for that day, is for a few minutes, and cancel it. Don't leave it for good till cancel. The sell order can be good till cancel, and it should be. Sell order, you keep it good till cancel. Buy order is for few minutes. So when we are entering the trade, so I am not only looking at what is looking good, I am looking at where we will exit at profit or at a loss. So both sides. So the determining the target is science and art, and this is where the skills is needed. And the target are like precision guided missile. So they are hitting. So I define it green, yellow, and red. Long time ago, I came up with this. Uh, so I try to think that how can I explain a complicated topic in a simple way. So a complicated topic, and so which can you can understand, or I can understand, or even my little daughter, she would, she and even the kids, they can understand what it means by green and yellow and red. So think about that. So I have three targets, and there's a reason for three. So green, yellow, and red. So I call them green and yellow and red. So I'll explain to you what is green. And then there is something I call beyond red. So I explain to you what is beyond red means. So beyond red is a special target. So I'll explain to you. So the green target is the immediate target. So think about it. If you have not attended the session, I explain in a simple terminology, or what do you call it? Um, example. So the green target is the target which has a high probability of hitting the target, reaching it, and within less time, like 1 or 2 days in a swing trading, so 2 days. So think about this. If I'm traveling from San Diego to Seattle, so there was a time where I used to travel from San Diego to LA, and I had to leave Saturday morning. So Saturday morning I leave and I have to attend an event in LA. So if I leave Saturday morning from San Diego, and I put the GPS time and it says 56 minutes. So there was a very high probability that when I leave San Diego, I arrive LA in 56 minutes. So it's so precise. Unless I take the exit, and I still do it. When I start the journey, I look at the arrival time, and then I compare it when I arrive, and then I see that what actually happened during my journey, and how long was my journey, and what was the distance covered, and how much I deviated. So things like that. So if I'm leaving from San Diego to LA on Saturday morning, there's a pretty good chance that I will arrive in 56 minutes if it's saying 56. But if I leave in the like Friday evening on from San Diego to LA, it may say 56 minutes, but may arrive at 2 hours and 56 minutes, because the GPS at that time doesn't know what else is going to happen in Irvine or in between. So it's like this. So when we are entering the trade, we know that this is the target, which is there's no resistance in between, and the chances are high that the stock will hit the target. And when so it has a high probability. So unless a few things happen in between, the traffic jam or some news came out, and then it deviated, and then it goes down, pull back, and then it comes up, and then it hit the green target. So instead of 2 days, it took 4 days. So when it takes 4 days for an option, when you buy at 6, if it hits next day, green target, the contract may be trading at $7 or 7.50. But if it takes 4 days, the same target LA, but it's not trading at 7.50. It may be trading at 6.80 or 6.60, something like that, because of time decay. So the longer it takes, even though the target remains the same, the percentage gain or the dollar amount is less. So, but just giving you the idea, so in case you don't know. So if you have 6 contracts, we send you the alert, sell 1/3 at the green target. Sometimes we send you the alert to sell half, because we know or I know that green is prudent to sell half of the position because it took a while for the stock to hit the green target. So now we are selling it half or majority because it took the time. But if the stock hit the green target right away, then we are only selling 1/3 or maybe not selling at all. So I send you the alert, don't sell, hold for the yellow target, because the yellow target is like, in the analogy, is like from San Diego, the yellow target is like San Francisco. So we crossed this LA in no time, in 56 minutes. Now we are cruising towards San Francisco, which is the yellow target, and we are going to Seattle. So think about this, the second target after the green target. So yeah, I call it yellow. And the yellow, so even my kids know that when daddy is supposed to stop, when the yellow light is there, daddy is not supposed to cross the yellow light. Especially my son, 5 year, he just like alert me, the yellow light, daddy. So the yellow light, so the way the yellow target is determined is there has to be some resistance level, some turning points there where the stock has hesitated before, some overbought level if you're going long, or some oversold level if you're going short. Something is there. And because the distance is further, so the longer the distance, the less the probability is that it will hit. The same, if I'm going from San Diego to Seattle, there's a pretty good chance that I will arrive LA alive. There's a pretty good chance. But if I'm reaching San Francisco, there is some chance that I will get the traffic, the speeding ticket. I may get into the accident, or I may not arrive alive. So there is a probability there. So the same way, there is a probability that the yellow target will reach not in 5 days or 6 days. It may reach in 10 days, or it may not arrive there. It just pull back just before the yellow. So there is some kind of a resistance. There's some kind of a turning point. So we read that, and based on that, then we determine the yellow target and send you the yellow target also along with the green and red. And then when that is happening, then I'm sending you the alert to sell half, or sometimes sell the 3/4 of your position, sometimes all the complete position. So whatever it is, we send you the alert, and it's all. So now think about this. I don't know your situation. I don't know your portfolio size. I don't know what else is going on. I don't know. It's you and it's me. So even though if I say in the green target, I say sell 1/3, you are the kind of person, trader, when you see little green, you book it because you feel good. So you sell it. And later I send you the alert to sell half at yellow. And then you say, no, I don't have any stock. Darn it. I sold everything on green. Or you're just following, and you have your own system, and you say, no, I will not sell even a little bit at yellow. I will wait for the red because I see something. So you seeing something which I'm not seeing, and it's good that you're seeing something better than what I'm seeing. But in general, if 8 contracts were bought, sell 4 or 6. So I send you the alert, and I have a way of documenting the alert, what kind of a trade alert, sell alert I have sent you. So I have a system where I track that I send this to 1/3 or sell half or sell majority. So I know all that, and accordingly I send you the alert. So sometimes I send you the sell rest. If I have sent you the alert before, sell half, then prudent thing is to sell rest. So depends on what is going on. I send you the alert. Now the red target is like reaching to the Seattle. Eventually the stock is when you leave San Diego, you go to LA, then you go to Santa Barbara, San Francisco, then you are eventually arrive in Seattle. And but Seattle is far. So the other day when we were traveling, so I put it on the GPS, and it says Seattle 20 hours from San Diego, 20 hours. So I said, are you kidding me? 20 hours? I have to travel straight driving and no traffic. And I'm not taking any exit for the gas or any, Starbucks, any meal. I'm just driving on a machine driven car and I'm reaching Seattle. So GPS is assuming that's what you're doing, 20 hours straight, but it's not going to happen. I will arrive I know I will arrive after 5 days because I will stop somewhere in Santa Barbara, then I'll stop at San Francisco, then maybe I take a detour. So that's why the I may never even go to Seattle. I may even, and this is what happened to me one time. I just stopped at San Francisco and never went beyond. And so I came back home. So there is a 70% probability of the stock doing the same philosophy. So the longer the distance, the less is the probability of the stock hitting the target. And the time horizon goes also further. So time, if the GPS is saying 20 hours, it's not actually 20 hours, it's like 5 days. So and then the red target, there is a very high probability of, because it has a major resistance and a major turning point or a major overbought level. So a high probability of a stock pulling back significantly after hitting the target. But I do send you, it's not like if we enter at 100 and 110 is a major turning point, we will exit at 109 or 108, not at 110, because 110 we will never see it. So it depends what else I have sent you. I send you the sell rest alert. So, or sell all. So this is the definition of green, yellow, and red. Now there is something I call it. These are the steps you need to take. So sometimes, so the way the stock works, when the stock gaps above the resistance level, so there is some major resistance. And when the stock gaps above the resistance, it has created its own life. It's like it has taken its own life, not taken, not, it's not like died. It created its new journey. So when the stock break the resistance, especially via gap up, so when the stock gaps above a certain major resistance, it creates a new leg up. It's like you go to the hotel, you take an elevator. So if you, let's say you are going somewhere and it says your destination is 110th floor. So the elevator is not going straight to 110. Maybe they will say, okay, take the elevator to 60th floor, and then you will come out, and then you will take another elevator, and it will take you to 110th floor. So it's and then 110 is like a penthouse over there, and it's beautiful. So this is the way the stock works. So there is those. So think about it. The 64 is the resistance level. So most of the stock, they go to the 60 floor and they come down, then they go up and then they come down. But when you take another elevator and going to 110, you take that elevator, it's going to 110 or 120. It's going to double the price. So when the stock conquers some major resistance in a meaningful way, and the most meaningful way, in my opinion, is a gap. So gap above with the volume, and it stays above that resistance level. So it creates its own landscape. It creates its new destination. So when that happens, the prudent thing is there are several things you can do. If it's hitting at the red target and it's not doing what I just described, you have to sell it, because then it's going to pull back. So you go to the 60th floor, and then now you're coming down to the first floor. So you sell. So when we see this, I send you the alert. But if it's making its own new journey, you can do many things. You can add to the existing position. You can sell the existing position because you have uh, gain. You can sell those contracts and buy more of a smaller price, or buy another strike. Maybe you buy another month, another strike. So there are many things you can do. You can create a vertical spread, so you lock your gain. So these are the strategy. So the same symbol, same system, different people adopting the different strategy depending on what the stock is doing at any given moment. So when this phenomena is happening, I send you the revised red target. I don't know who is holding what, because I'm not doc. I don't have a way of knowing what you are doing. The thousands of members, I have no idea, unless they're communicating and telling me that I did this and what do you think. So markets are dynamic. Traders need to be flexible. So you need to be very flexible, and flexibility works on both sides. On the targets get expanded and the target gets shrinked. So this is where the traders lose money. They don't realize the targets have gone shrinked. And the meaning, the shrink, what I mean by shrink is that when we enter at 100 and the target was 110, But because of all the resistance and all the thing happened between 100 and 110, now the market has created a new resistance level, and it is at 108. And if we are rigid that no, I will sell at 110, it's not going to happen. The stock has hit 108, and now it's coming down at 100, and it will go to 90, and it will go to 80. So so the targets shrink because of the things happen. So it's like this: we are going from San Diego to Seattle, and then um, even before reaching Seattle, something happened, and then you come back. Or you reach Seattle and then you get energized. So think about it: you reach Seattle and then you get energized. Something positive happened, and then you said, okay, you know what, I go all the way to Vancouver. And it happened to me one time. I was in Virginia, where I was, I'm forgetting, where the Ben Jerry factory is. So I was skiing, and when I was about to come back, I was with a friend, and I saw a sign saying Montreal, 85 miles or something like that. So I said, oh, Montreal, let me see how let's go to the border. And so new journey I started. I made, instead of coming down towards New York, I made a U-turn, and I started driving. And I drove, and I ended up in the Canadian border. And I did not have a document, and the officer, they let me make a U-turn, and I come back alive. So so I created a new journey, and I went into Canadian border, and I went into the inside the Canada. So think about this: if the stock, you reach the, let's say you reach Seattle, and then something happened, and then you are traveling a new destination. So you don't want to make a U-turn from Seattle. So this is what the market does sometimes, and it shows you, most of the time it shows you through the gap. So it shows through the gap, and the volume is there. So try to read the gap up, and the gap conquering a major resistance level. So various reasons to revise the red target. When that happened, I send you the revised target. If this phenomena is happening in the pre-market, I send you the strategy to hold the red. So I give you the level. I say, okay, this market is about to gap up. Let's say we are long, and if it does this during the first 15 minutes, do this. If it does this, then do that. Because um, when when the market is trading in a pre-market, you have to read the highs and lows, and then you have to know when the regular session opens, where it will land. It's like, is it, when it's going to land, is it going to create a twinkle twinkle little star kind of scenario, or is it going to fire a cannonball? First it creates a twinkle twinkle little star. It just lands somewhere, and then like fire, and then it starts to move up and up and up. So when that phenomena is happening, you know that the cannonball is fired on a China wall, and the China wall is damaged now, and there's no way the stock is coming down. It's going the other side of the China wall, and it goes further to Mongolia or whatever. So think about that. Look for the cannonballs or the gap after the gap up. So revisions of the target is sent, so adjusted upward for calls, and the same cannonball can be fired to the downside. So when that happens for the puts, I send you the alert. I replace the target, so I move the third target to second and second to first, and I send you the alert saying, if you're holding it, this is the. Sometimes we have not sold anything. It's just we get lucky. So that's called luck. When you enter a trade and then go long, and then the very next day the stock gaps up. There's not something you did. It's a skill. It's just luck. So think about it. You enter today long, and tomorrow the stock gaps up, unless all the positions are gapping up the day you enter and the next day it gaps up, then you are genius. But if out of 15 position, one of them gaps up, then it's luck. So think that we need to differentiate between the skill and luck. So, and then the target may also shrink. So we need to recognize if the target is shrinking. If it's shrinking, then you need to, don't be rigid, exit from the trade. Now, I maintain a various metrics. So I know which one I have sent, and I send you the trade alert accordingly. Sometimes the trade I send, I give you the price range because it's moving such a way that there's no fixed price for you to exit because it's so dynamic that I give you the range, the exit within this range. I anticipate and calculate what would be the option price at this when the stock is going to hit this target. And this will be the option price, bid price, not the ask. And I send you the range. So you close. Sometimes we need to close by the market. Another condition is this, which traders don't realize. Sometimes it doesn't matter how good is your position. If the market is hitting some major targets or major resistance, it doesn't matter how good is your individual position. That position will eventually get affected because the overall market is getting affected. So overall market has started to pull back and your position individual symbol is looking good. You still need to close your position because the overall market, eventually that position will pull back. So when that kind of phenomena is happening, so we need to close the position when the major index is hitting a major target. So think about this. You can even set a conditional order where the major index hit this target, close this position. You can even set the target. I'm just giving an example. Sell my Apple calls when Baidu hit this target. So these are called conditional orders and it's available on your brokerage platform. So you can do all this. So, so again, and also need to watch the pre-market situation. You need to watch the aftermarket if there is an earning news or something is coming up. So need to watch the pre-market situation. Need to watch the aftermarket situation where the high and the low is made, and especially if the event has occurred. If the major event has occurred, such as earning, etc., and the stock is gapping up in the pre-market hours, it better gap above the high of the pre-market. If it's not, then the stock has done its thing in the pre-market hours, and you're not going to see any action in the regular. If you see it, it's a trap. So think about that. So I send you the pre-market alert, um, so you can take action. Now, once you cash the beast, so this is where the traders don't make money. They have this need to be right and need to feel good. So when you combine the need to be right and need to feel good, we we hurt ourselves. And so need to feel good is we only feel good when we close a trade with gain. That's where we feel good. So and we have a need to feel right. So when we close the trade with the gain, we prove to ourselves that we are right. Look at me, I'm genius. I'm closing this trade, making $100, and I need to need to feel good and need to be right. And when we close the trade at $100 gain, the decision comes out that hey, you took this trade and you locked this $100 gain. You were right. So right and feeling good. So that's not the right strategy. So so we need to understand how we can maximize. Once we have a winner in our hand, how to hold the winner for a longer period or how to convert that winner into a bigger gain. What we do, if we have 4 open positions, 3 are losers and 1 is the gain winner. So 3 loser, they are losing combined, let's say loss of $1,000. And the winner have a gain of $1,000. So what we do, we close those 3 losers and we are feeling bad because our decision was wrong. We open 4 trades and 3 are losers. So it means we were wrong 75% of the time and only 1 winner. Now we are not feeling good. Our decision was wrong because those 3 trades are loser and we are feeling bad because we taking a loss of $1,000. Now what we going to do? We will close that winner at $1,000 and the net result, 0 loss. So when we have a 0 loss, we took this, closed this big beast, which is about to turn into a big beast of winner. We close it to make ourselves feel good that we didn't lose money for that day. So we did that and we feel good. Now next day, when the next day open, what we do? Now we are looking for a new trade. And think about that. The trade which we close, it may pull back. $1,000 may become 600, then 600 become 1,200 and $2,000. But what we do, we look for the new trade, because now we are in cash and we need to look for the new trade. And in order to open a new trade, think about all the things I told you. So we have to go through all that process for the new trade, and the decision we are making. So when we open a trade, we make a decision. We reach a certain fork. I remember I used to consult for Eli Lilly. I was a consultant for Eli Lilly, and I used to travel to a city named Bend near Chicago. And then when I arrived at nighttime, and the first time I arrived, and they gave me a rental car at the airport where there were only me. I was the only person, and I didn't ask for anyone the direction. And then I reach a fork where it says turn right or turn left, and I had no idea whether I need to turn right or left. But then I said, maybe I need to turn left. So I turned left, and I that was a right decision. And I arrived in my hotel, and next day I went to Eli Lilly. So this is the same way we are trading. When we reach a fork and we are about to make the decision, at that time you better be right, because you may turn right, and that's where the bad guy is with the chainsaw, and he's about to kill us. So that kind of scenario, when we see in the movie Cornfield, we turn right or turn left, they show it from the drone. So that kind of situation exists in every trade we open brand new. But then sometimes we get right, and then we end up in the hotel, and we say, yeah, we made the right decision, I'm in the hotel. So but sometimes we just go and go and go and reach somewhere, never ending road. So think about this. You have a winner in hand, you closing it to make yourself feel good, and you can show to yourself that the net result was zero. So don't do that. You can close those three loser trade, and maybe next day the money you have from those three losers, if the next day the trade, the one you have the winner and is showing a new sign, maybe is going into Vancouver from Seattle, maybe you put that money because you already have the winner in hand, you read it correctly. So in order to do that, so these are the trading strategy you can adopt. You can add to the existing position, you can roll up, buy the new strike same month. So if we have a March calls, let's say we have a March call, we bought, let's say 105 strike when the stock was 100 and it's trading at 110, maybe we can sell 105 strike and add another 110. Maybe if we had a February option and it's looking good now, we don't need to add a February option. We need to buy March calls. Maybe we can buy 110 strike or something like that. Buy a new strike, new month, or the new strike, same month. Maybe we can sell 110 strike against our long calls. So we created the spread. Now we have captured the gains, and maybe the rest is we let this trade do its thing. So different thing we can do. It depends on our appetite and the skill. Another thing, whenever a news update, so keep an eye on the news. So I keep an eye if any something new or newsworthy, I send you the alert. I prepare for most of my trade. I post it on my blog on Trade Genie, and I'm posting this on a YouTube channel. So I've created fundamental analysis. So there's something called rational analysis, and we need to do that. So the rational analysis is when you combine the fundamental with the technical. So the Venn diagram, if you create the fundamental into technical, the overlap, that's where the most of the winners trade are, when you combine the fundamental with the technical. So become a rational trader. So I do that. I post on my blog, and I share in the Facebook group and other places. Volume update. If I see something worthwhile, I send you the volume update, and I send you the alert to get ready to log in. So all this is going on. Sometimes, so there's something. Sometimes people say that never, ever buy average down a losing trade. So in my opinion, this is not the right strategy. Never, because if you bought something at 100 and you know that's going to 110, and now it's trading at 95 or 96, let's say, and it's making a rebound. So it took a time for a few days, and it just held on at 102 and 103, something like that. And then it didn't go to 110. It just pulled back below 100. Now it's trading at 98, and now it's making a reversal, moving up. So your option, which you bought at 5, is trading at 3. Now you have a concrete reason. The reason which was valid at 100 is still valid at 98, but the options are trading at $3. So why not buy some more? So when I see that, I send you the alert to buy more at $3. Sometimes another scenario, you enter at 100, and the target is 110, and it's trading at 104, and you have a gain. So the $5 option is trading at 6. Now there's something happening at 104 level where there is a new catalyst. So isn't it um, prudent to add more at the higher price, because it's a new catalyst and the stock is doing what you wanted to do, what you expected, and it's doing it at 104? You're already at 100. The option you were trading at 5 now is trading at 6. Maybe you can average down. Maybe you can add another month at that time, maybe another strike, or maybe you can buy some shares if you don't want to invest in the stock, in the contracts and the options. So maybe you say, okay, you know what, 104 new catalyst, I don't want to put more money in the option, but I can buy 100 shares. So I do that, average up or down. I send you the alert to buy more or buy more at the higher price or lower price. So it goes both ways. If you want to enroll in many of our services, you can send email to success@tradegenie.com. And this is our phone number, 212-930-2245. And the Trade Genie is almost open 24 hours. There's a 2-hour gap where we are not in the office. There is someone in the office to answer your questions, your email, etc., even on the Christmas day, even on the New Year's Eve. So send an email at success@tradegenie.com if you have any question, or when you receive our email about our offers, so you can enroll, or just go to tradegenie.com. There are 2 pages. One is the experience level page, and then there is a beginner level. So when I started the service, swing option service, so I was sending the alert at $8, $9, and then I received started receiving inquiries. Hey, you don't send any alerts for $3, $4. So I created a lighter version called Swing Light. So Swing Light is a lesser price, is $147 per month, and I send smaller price options. So if you have a smaller portfolio, less than 10,000 or 5,000, so you enroll in a Swing Light, which is a lighter version of a swing. And if you are into vertical spread, you want to trade vertical and you don't have time, so we have a service on ETF. Now, the most important service out of all this, even if you're a member, enroll yourself for the market trend service, which I will explain to you in another session. It requires a complete session, which is a market trend service. Market trend service is a service. So 80% of your success, actually you divide your success. So you can say 60% of your success depends on you, and 30% or so depend on understanding the market, and the rest of the 10% is on your risk management. A little bit left on acquiring the skills. So when you acquire the skills, when you acquire the risk management, when you understand the market and you understand yourself, when you put all these 4 things together, you understand yourself, you understand the market, you understand the risk management, and then you have a proper skills to trade. When you put all this, scale in and scale out, you have a winning formula. So there is a service which I offer at 97 for the whole year. It's about the market, understanding the market. So I will explain to you in detail in another session what that service is about, but it's 97 for the whole year. In that service, you receive, it's a world-class. I'm bragging right now, and it's true that it tells you exactly what the trend is. There are 3 kinds of trend: minor trend, intermediate trend, and a major trend. and I follow that myself. And I created the software where it tells you exactly what is the trend. And not only the trend itself has no meaning, because the trend can be choppy, the trend can be weak, or trend can be strong. So not only if somebody tells you it's trending, then you need to ask the person, okay, what is the strength behind the trend? So 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 the person needs to tell you that the strength is strong or the strength is weak. So I go deep dive into, I feed the data and I come out with the answer. I used to do it manually, and I used to sleep at 12 or 11 at night time. I used to do that, but I programmed it, and now my software tells me what is the strength of the market at any given moment during the day, especially at the end of the day. 5 times a week, I do the analysis completely, and I give you that analysis for 97 for the whole year. And the reason I want to do that, I can give you for free, but you need to understand, if you pay, then you pay attention. It tells you at any given day, at the end of the day or during the given day, I send you the alert. It tells you what is the strength, it tells you about the trend and the strength, and it gives you the warning shots also. So I put it in my market report. I send you the warning shots, and during the day I update you. And it also tells you about the volatility of the trend. You have to understand the volatility. If is it a quiet market, is it a normal market, is it a very volatile, is it a volatile, what else is going on? Because the market, when it's volatile, you have to take a different strategy. When the market is quiet, you have to take a different strategy. So the market can be uptrending and it becomes volatile, which doesn't happen that often, but it does. So you have a different strategy. If the market is downtrending, is very weak, and suddenly you know that this market will turn into volatile market, because the downtrending market turns into volatile market, and it's short-lived. So all that thing I provide you for 97 for the whole year. So if you don't find that offer, send email and my team will send you. Or when you receive an offer for 97, you enroll and pay attention to that. Because what happens is, you can monitor the market and you can increase your exposure based on the market condition. You can decrease your exposure. That's where the money is. Where the market is there are certain period in the year when the market is really good, where you accelerate your trading and you make a lot of money, and then you step back because the market becomes choppy and weak or neutral. That's where you step back and decrease your exposure. And then when the market accelerate, that's where you go back in and you increase your portfolio size. So I conclude with, again, the perfect kick. So the kick comes with the practice, and I really believe in the Bruce Lee's and trading mastery. So a lot of things get involved in the trading mastery is the consistency. It's not like, okay, I buy 10,000 shares at 45 cents, I sold it at 75 cents, I look at me, I'm genius, and then I go buy another 15,000 shares, and then it goes to zero. So that's not trading. So consistency, discipline, precision, adaptation. Think about Bruce Lee, mindfulness. So be very calm during the market, have patience. So these are the mental state, and each mental state requires triggers a process. So each mental state, so you have to think about this. In one trade, you are stalking it, so you're developing a mindset for patience. You have to adopt the patience. But on the other hand, when you're executing the trade, so another trade you're executing it, you need to have a mental state of being confident. So simultaneously, you're patient in one trade and being confident in having a confidence in another trade. So think about it. What is needed? So I have a course, 8-day course, where I go in deep into this, and it's a 2-hour, 8-day, 2 hours, so total of 16 hours. I provide you all the resources. I provide you the tests. I explain to you deep into this area. So the course, I don't know what's the price. I should ask you, but it's only $297. So if you receive that offer for 8-day course, I will teach you all what you need to do for 8 days, and I give you the tools and the references to the books which you must read. There are certain books which you should not. There are certain books which, like, I'm making a list for my 5-year-old son. that these are the books my children must read, and the list is growing and growing. So if you are into trading mastery, I give you the references to the books so you read it. It will take you a while to read and understand, but in 8 days you will have enough thing to work on. Believe in abundance, continuously learn, implement robust risk management. This is very crucial. Very crucial that you learn from your mistakes. Have a proper system of creating a journal and eliminating the mistakes. So I teach you that, and we all believe, we know that we need to have a positive growth mindset. So I teach you for 8 days, and I paid a heavy price. I invested a heavy price, and I learned, and I'm still learning because this is a big topic. So if you're interested in learning, contact my team. They will send you the offer for 297, and I will start somewhere next month. So there are a certain number of students, and then we start. So once again, leave every person you come in contact with the impression of increase. Or I hope you got some value in attending today's session. Wallace Wattles, and remember, you get rich by doing things in a certain way. So Wallace Wattles. So get hold of this book called The Science of Getting Rich by Wallace Wattle. Is free on Google, is free on YouTube. It's a 2 hour, and you have to read and listen again and again. So thank you, and I will see you in few days. I will teach you something else. So thank you for coming. Bye.